4 ways to safeguard one's portfolio from geopolitical risks. The surprise attack of the Hamas and Israel's subsequent retaliation has meant that there's been heightened uncertainty around geopolitics in the last few weeks, and there is a concern that this could actually escalate into something much bigger. As a result of that, equity markets across the globe have been correcting. Whilst geopolitical tensions do tend to be fairly common in the Middle East, it's important to keep in mind that every time an event of this kind happens, it does tend to create short-term volatility. If you go back in history and look at data, let's say starting off from the Iraq-Kuwait war when I was still in college, to what happened in Kargil between India and Pakistan, or what happened in the 9/11 and subsequent to that, or what happened with Russia and Ukraine just a year and a half ago, you will find that there has been a fairly consistent process, which is essentially markets react immediately, but that tends to be short-lived, and then they tend to come back. Whilst we know that it's impossible to predict what will happen in the future, we need to keep in mind that most of the time, these impacts tend to be short-term. So how do you protect your portfolio from these kind of situations? And how should you react when events of these kind actually take place? Number one, build a long-term perspective. While it may sound very basic, the reality is that when events of these kinds happen, there's lots of speculation in terms of what it might lead to, especially because at the start, there tends to be a market correction that accompanies it, especially if the event is unexpected. It is important to keep in mind that these bouts of volatility have historically tended to be short, and therefore, do not forget your long-term financial goals when events of these kinds happen, and react only if you actually must. Number two, have commodities in your portfolio. You will typically find that whenever events around geopolitics tend to happen, you will see that prices of gold and commodities like oil, because a lot of the oil producing nations are in the Middle East, tend to go up. And therefore, there is a negative correlation between what's happening in equities and what happens to gold and oil. It is therefore important to keep in mind that while equities might come back and these commodity prices might also correct, have a 5 to 10% allocation to commodities like gold and oil to protect your portfolio against events of these kinds as and when they happen. Number three, seek diversification. As we've looked closely at the data, we found that there is no one asset class that does well during these periods. You will find that different asset classes have done well during different time frames, and different geographies have done well during different time frames. And therefore, it's important for you to have a portfolio which has actually got a combination of all of this so that you are able to protect downside risk. Last but not the least, ignore headlines. You will notice that there is a heightened amount of news flow that tends to happen around a lot of these attacks and the possible subsequent events. This is what we would call a war paradox, where, while the war might linger on for a longer period of time, you might end up finding that the markets actually digest this news very quickly and move on. For example, if you look at the Russia-Ukraine war, the war is still ongoing, but the markets have moved on from there, both in India as well as overseas. So all in all, our suggestion is be careful of yourself during these time frames, avoid impulsive decisions, and remember that equity market performance will very often be a function of how the economy tends to do and how corporate earnings in the economy will do going forward.
Disclaimers. Investments in securities market are subject to market risks. Read all the related documents carefully before investing. Registration granted by SEBI, membership of BUSL and certification from National Institute of Securities Markets, NISM, in no way guarantee performance of the intermediary or provide any assurance of returns to investors. The information is only for consumption by the client and such material should not be redistributed. The securities quoted are for illustration only and are not recommendatory.